Dear traders, welcome. I hope you're all good. It's time for another episode of our MCA Trading Made Simple series. We went through all the main components of the market causality in the last videos. Again, please make sure to watch them in chronological order in order to have the aha effect and to understand everything step by step. I try to really make it as concise as possible, straight to the point, with real examples, with the concepts, everything in one go. The videos are rather short. I'm not like other trading educators waffling around for hours and hours, okay? I come straight to the point. Today we're covering a very, very important topic in forex, namely how the smart money algos deal with the economic news, how they use and rather abuse those items which are published every single week to their advantage. Okay? As you know, we have scheduled news almost every day, such as employment data in the US, CPI data, retail sales, interest rate minutes, and so on and so forth. So, what do you need to take into account when it comes to those news announcements? Let's go. Okay? So as I wrote here in the older video on this channel, the news principle states that clear results of news announcements are generally priced in by the smart money algos. What does it mean? That means, generally speaking, if there's a big deviation, let's say the GDP is significantly higher than expected, yes, that will lead to dollar strength. The algos will try to implement a price move so that there seems to be some kind of economic logic in the market. However, as you can see, I'm already emphasizing the word seems to be, because we will now go into detail and look at when they completely disregard any economic plausibility, namely if the dumb money was placed correctly. As nasty as it sounds, that's the reality. That's why sometimes you see a completely unlogical move in response to the news results. Okay? But I wrote some other important things. The bigger the dumb money bias, the bolder the smart money will behave. Okay, so that means if the market is full of longies, okay, they're gonna push the price down, whether the news are in alignment with that or not. Okay. Phishing and fake momentum are common phenomena when it comes to news announcements. We come to that also. And generally speaking, okay, it's not necessary for the algos to know the news in advance. Of course, there are the fastest market players, they have the fastest access, but it's not that, you know, they need to know the exact results. They have full price control anyways, as we know, okay? I also made this little overview, and that's relevant, yeah? The importance of the news, plus the expectations, plus the actual result, plus the previous news, plus most importantly the dumb money bias, we come to that. That will determine how the smart money algos will react to the news results. Yeah. So let's go through it quickly. News importance: unemployment is much more important than, let's say, monthly retail sales. Okay. It's not difficult to determine which news are important and which ones are not. It changes a little bit over time. For example, these days, any CPI data, any data related to possible interest rate changes tend to be market movers. Okay, the GDP is not so much of a market mover anymore as it was a few years ago. Okay, these things change over time and depend also on the macro picture. The expectation is relevant. Yeah, if the market already expected, like let's say the CPI data to be higher, okay, then this can be priced in. The actual result, so how much does it deviate from the expectation, that's important. If it doesn't deviate much, sometimes there's not much of a price reaction to the news, okay? And what's important, previous news, yeah? If let's say we are talking about retail sales, and let's say the previous retail sales, quarter on quarter, have been very high. If then the current result is also very high, I have what I call an added news effect. Okay, there's more pressure for the smart money algos to somewhat price in those clear trends in the macro news. Okay, the economic results. However, the most important factor by far is the dumb money bias. Where are the position bars, the stops, and so on. Okay, this is what we're going to go through now. Okay, let's start with a very, very simple example, as we always do. Yeah. This is euro dollar. Okay, so let's create a very nice example so it's really understandable. Let's say we have US unemployment, okay? It was expected to be, let's say, 3.5% or whatever. The actual result, however, is 2%. Let's say year on year, okay? So let's just assume suddenly the US unemployment is way lower than expected. Okay, so that's better for the dollar, right? What will the algos do in the current example here? You guessed it. They quickly price this in, they reverse, boom, and they take the upper stops. How can this be? If unemployment is lower, the dollar should get stronger against the euro. Meaning that euro dollar should go down, isn't it? That would be the economically correct price move. Well, now you see how this really works, okay? Because guess what? In this example here, we have the same scenario. The unemployment is significantly lower than expected, which is good for the dollar. So euro dollar as a whole should go down. What do they do? Boom! Boom! So what is going on here? Yes, you guessed it right. Okay, this is the difference. In this second scenario, we have dumb money longies in the market. The dumb money is long. Okay? The dumb money buyers bought euro dollar. They are placed on the wrong side. You see? Because the unemployment was lower than expected, which is better for the dollar, which pushes euro dollar down. In this scenario here, the dumb money is placed on the wrong side already. So what do the algos do? They do an exaggerated move to the downside. Okay, they do not only take the stops, they even go down further. Okay. What happens in this scenario? People are like, yeah, of course. Unemployment was lower, so the dollar gets stronger. What's the surprise? What people don't know is that in this scenario here, the dumb money was long. Okay, they were already long. They were trapped in the market. Therefore, the algos do an exaggerated move to the downside. You understand? So the algos are pricing in the news results correctly. Because the DM was long, okay? They were buying. So by pushing down the market, they destroy the dumb money longies, you see. Okay, let's go back to the first example. What happened here? You guessed it. We have dumb money shorties in the market, okay? The dumb money sold. So if the algos would price in the unemployment correctly and push the market down, these sellers would win. Is this going to happen? No, it's not going to happen. And those are the scenarios where the algos completely disregard any economic logic. They disregard the economic plausibility. Why? Because the dumb money was placed correctly. They were on the right side. They were short. Okay? The DM was placed correctly. So the algos, the smart money, simply implements a small fish move down, but then completely reverses the price. Do you understand that? It's essential to understand that. And again, the causality, the MK web tool allows you to see what's going on. That's the power of it. You don't need to be scared of news. Because as you can see, if there's a lot of shorties in the market, even if the results are for euro-dollar to go down, it won't go down after all. Okay? You need to understand the difference between those two scenarios. It's essential. And this is another reason why the causality is so powerful. This is a reason why you, as a blind trader having no access to those tools, you sometimes see the market going completely in the wrong direction. Because the money was placed correctly. As simple as that. Okay? Now, in the other older video as well as in the MK video course, I'll go really more into detail regarding these things. But I think the general principle here for now is more than enough. Just understand, to come back to this added news effect, as I call it. Let's say the previous employment data was all getting better already, yeah? Was improving. And then we have a strong news result. There's more pressure for the algos to somewhat price that in. But again, the dumb money bias takes priority. So maybe they do a bit of a deeper fishing move, but then they quickly go up and take all the upper stops. You see? These are little nuances for more experienced traders. Okay. Let's look at real life example as well. So look, this is Kiwi dollar on a day chart. I would like to draw your attention to this bar here. Okay, this one, this big down move. You see? This day, the market just crashed down with the news. It took this low, it took this low. Why? Because we had all these dumb money longies. We had a squeeze against the longies. Okay? Loads of dumb money buyers. The news are coming out. They're somewhat in the right direction. Not by a lot of deviation, by the way, but slightly bullish for the dollar. So what do the algos do? They do an exaggerated move down, killing all these dumb money longies. And look what happens. They collapse as a result. The dumb money longies collapse. They take the last stops and then they bounce back up because the longies are kicked out. You understand? This is how this works. Now, imagine that these bars would be red. Yeah? Let's say this is all red. Sellers. We have a squeeze against the sellers. So what would happen? Short, a slight fish to the downside, with this, and then boom, accelerated up move. With the same news results, you understand? You understand? This is what matters, nothing else. This. Okay? And now you see also why news trading overall is dead. There used to be a time, like maybe 6-7 years ago, where people were very keen on trading the news. They have no clue what the dumb money is, so consistently that won't work, okay? So this has completely died. All these traders are lost and got kicked out of the market. Okay! So, understand these points. It's very important. This is how this works, okay? The intensity the smart money algos react to the news results depend on what the dumb money did beforehand, okay? You find many more and more extreme examples in the larger video as well, in the older one. This is always the case, okay? For every single news announcement, these are the relevant factors. And This is basically what happens. Now, by the way, if you are a short-term trader, you may want to try to really avoid news. So you try to really close trades or reduce like 40-50 minutes before the next big announcement and so on. Generally speaking, new traders should really try to skip the news. More experienced traders sometimes may even trade the news or at least hold in. It depends, okay? But if you're a beginner, don't even attempt to trade any news, okay? And even if you're an experienced trader, you still should really decrease your leverage. Don't hold massive positions over news. That's very dangerous anyways, because spreads get wide, there's slippage, and so on and so on. Okay, I think that's enough for now. I hope you liked it. Lots of love. Take care. Goodbye. Stay safe.